I think of you as a treasury guy, but would you be recommending investors go to munis right now for a safe spot?
Yeah, absolutely. The longer end of the muni curve, call it from 7 out to 15-year maturities, is one of the few pockets of value left for investors, particularly ones who, of course, can take advantage of the incremental tax exemption, which isn't something that's fully priced in by the markets, and frankly, over the last cycle has never been.
Why? Why is that?
Well, perhaps it's because of a segmented market, right? There's not a lot of corporations or certainly not international issuers who can take advantage of that. So the narrower market, the sort of less traditional, or rather more traditional trading within those markets, really I think helps leave it in a position of value in the long run.
What about the rest of the fixed income space? Do you think overvalued?
Sure. So
bond yields bottom?
Yields have come plummeting down, particularly over the course of the last 3 weeks or so. And I think there's a few things behind this. One is a genuine expectation that economic conditions might deteriorate early next year. Two is lower yields in many foreign markets. And three is some concerns related to market plumbing. We've got a great deal of Treasury issuance coming up towards the end of the third and into the fourth quarters. That may strain dealer balance sheets, be able to take down this Treasury issuance, and force the Federal Reserve to act even more aggressively, thereby supporting bond market valuations.
I wonder if you think is the issuance going to have an impact on rates? Are we finally at that day?
So it doesn't seem to be, and certainly not thus far. I mean, debt to GDP ratios here in the U.S. are set to accelerate a bit during the back half of this year, but it really doesn't hold that much concern. Again, the bigger issue, I think, where it comes to debt issuance is how the debt issuance is straining dealer balance sheets in a world where dealers are becoming capital constrained by regulations that weren't here in the last economic cycle.
So what is the risk, as you say, to market plumbing if, in fact, that occurs and those dealer balance sheets get strained? What actually happens?
Right. So the dealer community ends up in a kind of an awkward place where they're basically capital constrained, can't buy as many treasuries as they're essentially forced to do by the heavier issuance, and the Federal Reserve has to respond to that with one of a couple ways. One could be a much more aggressive rate cut than is currently priced in. Another option could be the launch of mini quantitative easings or sort of short-term bond buying sprees to help alleviate the concern of constrained dealer balance sheets and excess Treasury issuance.
That would make the president happy, wouldn't
it? Perhaps it would. It's one outgrowth of balance sheet, or rather, I should say, deficit expansion to the degree that has happened.
So what are you telling clients, Guy, about the inversion of the yield curve? And it feels like the market equity investors have a pretty simplistic view. It's a recession indicator, could come in the next year or so. Is that what you guys are saying, or is there something more granular we should know about what's happening right now?
So the inversion of the yield curve is a great signal that a recession is coming. It's a horrific signal about when a recession is coming. If you take a dart and you throw it at a calendar, or you hit any given year, there's about a round numbers, about a 10% chance of recession, 12% chance of recession in that year. In a good year, that number, sort of based on new information, might go down to 5%, it might go up to 40%. I think we're up towards the higher end of that spectrum, 40% of recession risk within the next 12 months. And that's a large part in reflecting what the yield curve is telling us.
So, for investors who are looking to narrow down that widespread of time that history has given us between inversion and recession, what clues do we have, if any? Is it 4 weeks? Is it 22 months?
Mm-hmm. Right, and we don't have the perfect answer for that. Recessions, by their very nature, are nearly impossible to predict with any confidence. But we have a few clues, right? The fiscal impulse, incremental spending from the federal government, even with the budget deal that was recently passed, becomes sort of, rather than a tailwind to the economy, it becomes roughly neutral to the economy in the beginning of 2020. CapEx plans from the CFO and CEO community seem to be slowing down a little bit. And those are sort of the fundamental risk factors that are more sort of timing evidence than it is just the inversion of the yield curve. And they're kind of hinting somewhere in the early to mid portion of 2020.
But then when the White House, trade advisor Peter Navarro comes out, Guy, and says it's just a reflection of the fact that everybody wants our debt. We have the highest yields compared to all of Europe, which is going completely negative. It shows the strong fundamentals in the U.S. Can you make that argument?
Well, comparatively, I suppose. But if you're a treasurer of a European bank or a Japanese bank or insurance company, when you go out and buy United States dollar debt, you need to hedge the currency risk. And after accounting for that hedge, ironically, U.S. dollar debt out past roughly 5 years provides a lower yield than domestic debt in euro terms or in yen terms.